my colleague Viral Acharya, we have Subbarao, and we have Darrell Duffie. So I'm going to turn it over to Viral, and he's going to start the panel discussion. He's going to start the conversation on ERP, CBDC issues, and the digital economy. Viral, you take over.
Thank you, Kos. I think I should confess right at the outset that other than digital banking, cryptocurrencies and CBDCs are not exactly my forte, but I've been learning about them over the last 2 years, probably like many in the audience. So I'll pose some questions that Darrell and Dr. Subbarao could use just as segues to inform us in any case about the remarks that they had in mind. Maybe I'll start out with Darrell, if that's okay, Dr. Subbarao.
Sure.
I had two sort of questions in the context of India specifically on crypto assets. The first observation is that India has one of the most advanced payment systems as far as the banking exchanges are concerned. As many in the audience know, it's called the Unified Payment Interface, UPI. It's a set of software standards, APIs as they are called, or pipes, which connect banks through a central utility for payments, which is sort of essentially a public utility for all practical purposes. And on top of the sort of unique identifier and its verification, that creates a very seamless way of doing interoperable payments between any two individuals and the government, individuals and the businesses, business to businesses, and so on. So my question for Darrell is, in a world like this, where most of the payment efficiencies are already realized within the banking system, what do you see as the role of cryptocurrencies as a medium of exchange in a country such as India or some other developed markets which have similarly evolved payment systems?
Thanks, Viral. And let me just take a moment also to thank Professor John and, of course, Dr. Subbarao and yourself for the chance to appear here. It's a really wonderful opportunity for me to learn about the situation in India. And, of course, answering a question about the situation in India is treacherous for me because I'm surrounded by the experts. But let me simply reemphasize the irony in your question, Viral. The irony is that countries like China and India that already have very advanced mobile payment systems, at least in the case of China, throughout its urban centers, over 95% of city dwellers in China are using mobile payments on a daily basis, even before the digital currency arises. And with the benefit of UPI, which you mentioned for India, plus the identity systems available, including Aadhaar, it would seemingly be the least important of the major countries to make a case for a central bank digital currency, given how advanced it is already, and the potential future for commercial bank railed payment systems like UPI. But nevertheless, as we all know, because that's why we're here today, RBI's Governor Das has already initiated pilot testing starting this month in India on the basis of, I would say, making sure that as paper money is reduced in circulation in India, partly under the efforts of the government, that there is still an official digital currency representing official fiat currency in circulation. That's the reason that Sweden, for example, which already also has mobile payments in a very good state, is introducing perhaps the e-krona. I don't think this move necessarily means that the RBI will go ahead with this project. Governor Das has already mentioned that there are some technical hurdles like security and also making sure that the CBDC doesn't disrupt the banking system. In my view, by the way, I think the banking system in the United States deserves a big amount of disruption in the payments area because they're not doing a good job. There's not enough competition in the US for CBDCs. CBDCs are not here to compete with banks, and the payment system in the US is very inefficient and costly. But India, seemingly the banks have this under control, and the case to be made for a CBDC has to be made based on perhaps the new digital economy and smart contracting, or perhaps the fact that the RBI wants to be sure that as paper money goes out of circulation, that there will be an official fiat currency in circulation in digital form. I think those are the best positive cases. There are negatives as well. The private sector can often do innovation more effectively than the government sector. So one may ask, why does the central bank need to do this? And that debate is going on all around the world, where most countries are grappling with this issue. But let me not go on at greater length, Viral. You asked the best question first.
Thanks. Thank you, Darrell. Let me turn over to Dr. Subbarao. Sir, in the context of India, what do you think has given rise to cryptocurrencies as a medium of exchange, in spite of the payment efficiencies that Darrell has also referred to? In fact, payment efficiencies even relative to fairly advanced financial systems such as those of the United States. And the second related question, if I could throw in, is where do you see the role of central banks' digital currency in India? Do you think there is a strong case? If yes, what are the merits and what might be some of the pitfalls that RBI would have to worry about in due course?
Thank you, Viral. Let me first address your second question, which is what is the motivation for the RBI to issue a central bank digital currency? I think India and several emerging markets are driven by both fear and opportunity in issuing CBDCs. Let me first talk about the fear dimension. The fear is that the private cryptocurrencies will come and displace the fiat money issued by central banks and thereby impair the monetary policy sovereignty. Let me give some context to this. When Bitcoin came out a dozen years ago, when I was governor of the Reserve Bank of India, central banks were quite nonchalant about it because they believed that Bitcoin cannot actually take over fiat money in all its functions, like unit of account, the medium of exchange, a store of value. In the event nothing like that happened, Bitcoin and its clones degenerated into just asset classes. But the story can be quite different with stable coins. Unlike Bitcoin and its clones, which are backed by nothing more than an algorithm, stable coins are going to be backed by reserve assets, such as the dollar or the euro, one-to-one. If they're backed by reserve currencies, they'll have the gravitas to pull transactions away from the banking system into their own medium. When that happens, central banks fear that they will lose control over the setting of the interest rate, over money supply, and therefore over inflation management. Is this probable? Who knows? Consider TM, the stable coin to be issued by Facebook. Facebook has a client base of 2 billion, has a very enticing suite of services, has enormous network impact. It can compete with fiat currencies, with domestic currencies of emerging markets and displace them. And central banks are worried that as the use of their own currency diminishes, they will lose monetary policy transaction. What compounds this worry is that most stable currencies are going to be linked to the dollar, because the dollar is the world's dominant reserve currency. And I think America itself is going to be quite nonchalant about regulating stable coins linked to the dollar. In fact, America might see that as an advantage because it will extend the dominance of the dollar around the world. So we'll land up in a situation where there are stable coins linked to the reserve currencies, is linked to the dollar, America being nonchalant about regulating them. So outside of beyond the regulatory gaze, these stable coins, what is to prevent them from delinking from the peg and becoming independent creators of money? So central banks like the Reserve Bank of India are, I believe, concerned that when cryptocurrencies like stable coins gain dominance, gain traction, their monetary policy will lose traction. I think there's also another reason. Let me give another important reason why central banks have driven into CBDC, particularly emerging economy central banks like the RBI. Like Darrell said, cash is on its way out. Even before private cryptocurrencies came, cash has been on its way out. In Sweden, as he said, it's difficult to find a paper krona bill. In China, most young people have not seen currency. All they know is Alipay and WeChat. Even in India, the first generation digital payments like credit cards and debit cards, they've given way to private wallets, mobile payments, online payments, technology platforms like Google Pay and Amazon Pay. So what's happening around the world, including in emerging markets, is that people are increasingly depending on private payment systems. And these private payment systems are vulnerable to hacking, vulnerable to outage. And if that happens, central banks are concerned that the integrity of their domestic currency will be impaired. So they want to provide a backup, fail-safe, centralized payment system via the CBDC. So those are some of the two motivations driven by anxiety, driven by fear, as a defensive reaction that is motivating central banks of emerging economies like the RBI to go into CBDCs. I'll stop there.
May I react, Viral?
Absolutely, Darrell. Yes.
Yeah. So I think Dr. Subbarao has made the most perceptive points on why many countries are introducing CBDCs, which is they don't wish to be invaded by foreign digital currencies, whether based on a reserve currency or an undesired cryptocurrency. My country, Canada, has developed a CBDC. It's developing it now. It's not deploying it until necessary for exactly this eventuality. And the European Central Bank has said the same thing. My view, however, is that countries such as India can afford to be somewhat nonchalant relative to a small open market, emerging market economy, which has open capital borders, and which would have a difficult time preserving its monetary sovereignty in the wake of a global, let's say, dollar stablecoin, as Dr. Subbarao suggested. But in the case of India, again, I'm speaking treacherously here because I'm surrounded by experts on India's financial system. But I would have thought that because, first of all, it has some degree of capital controls, because it is such a huge monetary system, the world's largest democracy, also probably has the largest number of currency users, in this case, the rupee. And because it, as you mentioned, Darrell, India has made vast leaps forward in digital payments. It already has effectively a very stable, effective mobile payment system that, in my view, would do about as well as a CBDC in deflecting any undesired foreign digital currencies. I do agree, by the way, with Dr. Subbarao's comment that it would serve U.S. foreign interests to have a dollar stablecoin circulating widely throughout the world, even though, however, it would be disruptive to small emerging market economies. And therein is a challenge for U.S. policy. I'm pretty confident the Fed and other central banks will not wish to have their CBDCs circulating internationally in an invasive way. But then with respect to foreign policy, what about private stablecoins? For example, USDC or a diem. Would a country like the US sit back and let another country with a large dominant currency allow its stablecoins to get in place a kind of monetary regime in a region of the world. China might be an example. China has a stablecoin in development called CNHC. So if I were a small emerging market economy in, let's say, the southeast side of Asia, I would be putting up a CBDC right away, or some other effective digital payment system in order to ingrain the use of the local currency, just as suggested by the premise of Dr. Subbarao's question. But then will the superpowers allow stablecoins to compete in these areas? We don't know yet, but it is a temptation.
Can I just ask one follow-up question on that, Darrell, since you mentioned the possibility of a US CBDC? I think Dr. Subbarao also alluded to this as either a private or a public US CBDC becoming part of the international reserve system. There's this sort of interesting recent paper by Gorton and Zhang, which compares the stable coins to the private banknotes, in the last century. And one of their conclusions is that the value of these stable coins is fluctuating quite a lot, and in a manner that you would think it should if the quality of the money was somewhat imperfect in terms of being able to meet the settlement standards. How do you see this evolving? Do you see this simply getting disrupted over a period of time once these stable coins run into their problems, perhaps in some idiosyncratic manner based on the reserves management? Or you think that these stable coins are likely to get regulated with the purpose of actually ensuring that their value, given the quality of the assets they manage? So sort of, are we looking at sort of strong prudential regulation of stable coins, just like banks, so that, just the way deposit value stays very close to one, the CBDC values, the stable coin values will also likely stay close to one? Then I think it becomes a question of whether US needs a central bank digital currency, or does it need to simply do better prudential regulation of these private stable coins? What's your thoughts on this, Darrell?
Oh, thank you. Yeah, you've asked a $64 trillion question, Darrell. That's the big debate going on in the US right now. And I've suggested that the United States needs to develop the technology for CBDC. But as far as deploying it, it's the last resort. There are other ways to get the US payment system working better. Stablecoins is one of those. Improving the bank rail payment system with regulation and inserting competition into the bank rail payment system and innovation would be my top choice. But going to stablecoins, Viral, you may have seen the President's Working Group report on stablecoins, which came out last month. In fact, Undersecretary of the Treasury, Nellie Liang, who led that project for all of the US financial regulatory agencies, introduced the report here at Stanford University in November, we're proud to say. And that report weighs the costs and benefits that you described are all very carefully: financial stability, investor protection, proper reserve backing, as opposed to the national banking era currencies. And it ultimately recommends that Congress pass legislation requiring that a stablecoin can only be issued by a depository institution, a bank, in other words, regulated for its reserves and liquidity, and the entire regime of liquidity and capital requirements would be behind it. And so it would be in principle as safe as bank deposits. However, even the Governor Chris Waller of the Federal Reserve has said, this is overly conservative. How are we supposed to give banks a run for their money, literally, with competition if the banks themselves are solely responsible for issuing these stablecoins? Whether it happens through this form of legislation or otherwise, I do expect that any significant US dollar stablecoins issued from within the United States will be heavily regulated for prudential, both macro and micro prudential safety. And I expect that, let's say, a CFO in Germany wishing to pay for equipment coming from Ohio would be happy to use the regulated US dollar stablecoin to bypass the expensive correspondent banking system. And I think there is a good marketplace for both cross-border and domestic payments in stablecoins. So I would be, if I were investing in these sorts of enterprises, I would be investing in a well-regulated US dollar stablecoin.
Thank you, Darrell. That was very clear.
Before you move away, can I respond to some other points made by Darrell? Because we lose the thread. While talking about India, he said that India's case for issuing a CBDC is not very strong because we have capital controls, we're a democracy, we're a large country, we're a large economy. All those points are well taken. But as I said, if other countries are doing CBDCs, India just cannot sit by and watch, especially if industrial countries like the US, Europe, China are doing digital currencies. India just cannot sit back and say that we're a large economy, our capital controls are strong and good. And second, India's capital control defense is not all that strong as people believe it to be. No, cryptocurrencies can jump capital controls. China lost $80 billion last year through the conduit of cryptocurrencies. So India's capital controls are also leaky. But apart from the fear and anxiety, I think India is also driven by some positive considerations, which is the transfer payments. Yes, because of UPI and because of a number of other digital payment systems available, transfer payment costs have come down, but they're still quite significant, especially cross-border payments. Our Indians working in the Gulf today, millions of them still spend about 3, 4, or even 5 or beyond 5% of the money as fees for remitting money home, and that's quite substantial. Even for domestic payments, costs in India are quite low compared to other countries, but they're significant. We just don't see them because they're hidden. You know, when you use a credit card or a debit card or a mobile app, that cost is hidden, is paid by the merchant, and that merchant is distributing the cost via prices. So if we issue a CBDC, I see a possibility of transfer costs coming down, of prices coming down. So apart from fear and anxiety, there's also a positive motivation about bringing transfer costs down, about preventing counterfeiting of currency, about reducing the cost of printing and distributing of currency. So that's the first part. I also want to respond to this issue about stable coins and the point you raised, which is that stable coins are supposed to be linked to the reserve currency, and they're expected to maintain that peg. At the moment, nobody is regulating them. So my point is, who is going to control, who is going to ensure that they're going to continue to maintain that peg? And if they see that no regulator is watching them, what is preventing them from delinking from the peg and creating money independently? Then they become like a bank. And they're not even regulated like a currency, much less a bank. So I think we've got to be more circumspect about the possible ramifications of stable coins, especially stable coins linked to the dollar from an emerging economy perspective. I'll stop there.
Yeah, I have 2 follow-up questions. Let me first start with you, Dr. Subbarao. You mentioned about paper money in India being replaced by digital money. And I think most people at a 10-year horizon would predict that perhaps cash, even in a country like India, which seems to love cash by and large, that cash might disappear. Yet it seems that the last 18 months have been a bit of a paradox in the sense that the pandemic has increased both the circulation of cash in the economy as well as the fraction of transactions which are being settled digitally. Do you think this is just a one-off that is linked to the pandemic, or something else is going on as far as the Indian economy is concerned? This surge in cash that's coincident with the surge in digital settlement?
Yeah, first of all, as a preface, I want to say that lower income people with lower literacy, lower awareness levels have taken to digital transactions in India than we could have possibly imagined. 10 years ago, if you said, can poor people, can your maid, can your driver, can your servant use digital transaction, we'd be amazed about how they become quite savvy about it. So first of all, to believe that low awareness levels and low income levels come in the way of adoption of digital currencies is a misnomer. But having said that, I take your question, I know where you're coming from. When India did demonetization 5 years ago, the expectation was that people will shift from cash to digital transactions. That happened during that period of about 3-4 months when you were probably in the Reserve Bank at that time. But then people slowly switched back to cash. And then over the pandemic, over the last 2 years, the currency circulation has gone up to about 14%. I believe people are holding cash today as a precaution because there's a lot of insecurity around them and they're concerned about a lot of outcomes, lockdowns, about being able to buy. So I think people are holding cash as a precautionary measure, but the trend, I believe, is from cash towards digital, although cash is not going to disappear.
Thank you, sir. And let me follow up with a question for Darrell. Since the working group explicitly considers some of the financial stability implications of stablecoins, one interesting financial stability implication of CBDC that also seems to be flagged. I was just exchanging some emails with Charles Goodhart in UK today morning, and one of his points was that, historically we have treated retail deposits as being a core deposit base of the banking system that won't switch banks at the first sign of stress or bad news about the bank, unlike wholesale deposits. But he questioned whether with central bank digital currency being a possible option for the savers, whether this would necessarily be the case. Since we don't have a CBDC that's been rolled out yet, of course, anything one says on this would have to be speculative. But I just wanted to hear your views on what financial stability considerations do you see from the introduction of a CBDC from the standpoint of the banking system itself, when there were to be some stress affecting a part of the banking system?
That's a terrific question, Viral. And if I had to say what is the main roadblock to the introduction of a CBDC in the United States, it's over precisely the question you just raised. There are technology issues like privacy and the ability to monitor transactions, but the biggest concern, in my view, of the US official sector is that introducing a CBDC, or for that matter, a vibrant stablecoin-based payment system, would disrupt the banks. And the disruption could take two forms. In a stress period, as I think you hinted, it could make it much easier to run on weak banks. The other, I'll come back to that. The other disruption is more long-lived. If a CBDC were effective enough, it would, as you suggested, make it very easy to move your money around, in fact, programmably, shopping for the best deal and competing against the existing payment system. This would be quite disruptive to bank profitable franchises. For example, deposit taking. In the United States, and I think in many countries, banks have the privilege of being able to raise funding through deposits at extremely low, below market rates. And this is viewed, well, by some as a negative. I'm one of those, but by many as a positive, because it would seemingly make the funding of credit by banks more available. That is, if banks, it's the story would go, if banks can raise cheap deposit funding, then they can make cheaper loans. I think that's a fallacy, because no bank would make a loan to a borrower that where the money would earn less than it would if invested in marketable securities. So the hurdle is not what is your funding cost, it is what is the next best available investment. A banker is not going to say, well, I'll lend money to Darrell Acharya Incorporated, because even though he's a fantastic, even though I will lose money on this loan, I'll make it up on my cheap deposits, and I can afford to make a loser loan in this case, if you don't mind my using you as a guinea pig, Viral. So the argument that credit provision would be harmed by making the payment system and the deposit system more competitive is, in my view, not correct. Although there are exceptions, and I don't want to go on too long, there are exceptions related to outlying rural banks. The other issue is the issue of runs. And there I do think that the authorities would need to be very careful with respect to how large these central bank digital currency positions could be and how well the banks are protected by capital requirements, liquidity requirements, and lending of last resort, like discount window access. Those mechanisms are all available, and they should not be a roadblock to the introduction of a central bank digital currency.
Thank you. I think we have about 20 more minutes, Coach, before we throw it open to Q&A. Is that correct, Coach?
Oh, I thought we are transitioning at 9:35. So we have about 10 minutes.
Okay. Yeah. Okay, we have about 10 minutes. Okay.
And so then we have 15 minutes of Q&A. That's right.
Okay, excellent. Okay. So I have two quick themes I want to shift towards. One is on the crypto side of cryptocurrencies, and the second is on the asset side of the crypto assets. So let me start with the crypto side first, and I'll ask both of you to give brief responses to this query, if possible, which is one value of, or one characteristic of a currency. One of my fellow deputy governors at the time I started out at the Reserve Bank, DG Gandhi, he always used to say that, you know, any currency, for it to function well, has to have two properties. It has to be very easy to transact in, and it has to give anonymity to the user. So I wanted to come to the crypto part of the currencies, which is that one of the attractions of sort of using these mediums of exchange? Do you think, is it just a coincidence that the growth of crypto has coincided with anti-money laundering rules and the like? And the parallel question then is, if a central bank digital currency technically has records of all transactions staying with the central bank, even if in an encrypted manner, do you think this could be one of the resistances to using the CBDC in the first place? Because maybe the end user thinks, oh, you know, this is really just a central bank, but it's really part of the big government. They're going to see my transactions. I don't really want to transact in this. Whoever wants to go first. Dr. Subbarao, do you want to start out?
Yes. On your first question, Viral, about the use case for cryptocurrencies. As I said earlier in my remarks, when Bitcoin first came, it came with a libertarian fervor of freeing people from the tyranny of fiat currencies issued by central banks, that it will displace money in all its functions as a unit of account, as a medium of exchange, as a store of value. But in the event, it is not a unit of account, it is not a medium of exchange, it has just become an asset. So I don't see cryptocurrencies now or in the future becoming mediums of exchange or units of account. They might become stores of value, they might continue to remain as an asset class. That is why I think there is a lot of concern in emerging economies, including India. There is a lot of speculation, there's a lot of anxiety, there's a lot of comment and debate about what the government is going to do in the proposed cryptocurrency bill. Are they going to ban them altogether? Are they going to allow them? If they're going to allow them, with what sort of conditions or guidelines will they have for allowing certain cryptocurrencies and not allowing some? We don't know anything at all. But they're all in a black box. But I believe there is really no use case for cryptocurrencies, except that they have become an asset. And as long as people invest in them, they've got to be regulated as an asset, both for financial stability reasons and for consumer safety reasons. So it's something forced on us. It's not something that we would welcome. Okay, but if the craze eventually vanishes, of course, central banks and governments can withdraw. On the second question of privacy, I think that's an issue. because cash is anonymous. If I go to a grocery store and run up a bill of 800 rupees, I pay in cash. The transaction is final, complete. There is no footprint at all. On the other hand, if I use CBDC, there is a trace of that, there's a footprint of that. It will, of course, prevent illegal activity like money laundering, drug trafficking, etc. But even honest people might feel uncomfortable, like Darrell said, about the central bank or the government keeping track or having access to all transactions. Why should the RBI or the government know how much ice cream I'm buying every month or what luxury brands I patronize? So there's a certain level of discomfort. And I think if you have CBDCs, you have to have very robust data protection laws, which are credible, not only to people within the country, but to people outside. So data protection laws are very, very important in issuing CBDCs. And I'm sure that this is one of the issues that is engaging the Reserve Bank of India and indeed several other central banks. Let's stop there.
Thank you, sir. Darrell, do you want to chime in?
Absolutely. Again, you're asking the best questions for all. So on the issue of the use cases for cryptocurrencies, well, there's a broad set of them. We discussed stablecoins earlier, which are a form of cryptocurrency, and they can have a useful application when properly regulated for stability and all of the other requirements. But there are cryptocurrencies, and I agree with Dr. Subbarao, that are used primarily as an investment asset. And I would think of the situation as close to that of gold. Gold has a number of fringe applications, jewelry, some industrial uses, but by and large, the gold trading in the world is generally around speculation about whether the price will go up or go down. And I know that India, many people hold gold as an investment asset. So I think of many of these cryptocurrencies as speculative assets with a fringe application. What about those applications? Well, some of them are illegal, and I'm going to choose my words carefully because when I spoke about this in the U.S. Senate Banking Committee earlier this summer, I got the next morning 700 extremely nasty tweets telling me things that I should do that I won't repeat here. But some of the uses are illegal. Some of the uses are not illegal. For example, in El Salvador, Bitcoin has been now designated as a recognized currency, mainly because I think of remittances. And there are small countries with weak monetary systems whose currencies are not reliable, where perhaps a cryptocurrency, if there's no substitute, could serve a useful purpose. That said, though, exactly as Dr. Subbarao suggested, they need to be extremely heavily regulated for investor protection and for financial stability, and of course for proper use as a payment medium. And I think that can be done. On the second issue of privacy, I think this is the most difficult design question. There is promise of the computer scientists coming up with cryptographic methods that would prevent anyone other than the receiver knowing that the payment has been made, and in many cases, knowing the identity information of the sender. And that's appropriate for most payments. In the case of the European Central Bank, it's been mooted that every consumer would be allowed up to a certain number, let's say a few thousand euros a month, of completely anonymous payments. But in order to ensure that, you need cryptographic methods. But you also need methods by which you can study the data and detect patterns suggesting illegal payments, allowing you to break open the veil of cryptographic secrecy. And this is a design problem that's still being worked on. It's premature to say that this can be easily solved. And that's why I suggested earlier, a country like the United States should get busy on the technology, because it takes several years, not only to get buy-in from the public and all of the agencies and banks and everyone else that will weigh in politically, but also simply to do the necessary design work and field testing. And I think that's why perhaps the Reserve Bank of India is beginning pilot testing. I think it will be quite some time before a satisfactory design can be found. In the meantime, consumers might wish to be suspicious about an entity that has all of the payments data in the economy. China is doing it, but China has a different form of political system that makes that possible. I don't think not all Americans, but very few, perhaps Americans would be happy to just say, yeah, let's give the government all of those data.
Just one last question before we take some questions from the audience. Maybe, Kos, you can consider this as a Q&A from the audience, counting me as one of them. And that this relates to the asset side of the crypto, which is that I think Darrell mentioned the similarity between gold and some of the crypto investments. In fact, it's routine in Indian investors to talk about the new crypto bill that is likely to be disclosed in January, in the context of that, to say that it's going to cause cryptos to tumble in valuations and gold to rise. The two are always spoken of in the same vein. The broader question I have then is, to what extent have negative real rates pretty much everywhere in the world contributed to the speculative interest in this asset class, and whether once we reach normalization of these rates over the next 1, maybe 2 years, do you think we risk something like a correction as we had in valuations of gold from $2,000 to about $1,300 in a relatively short period of time in the middle of the last decade? So I wanted to so the question is, what do you think is the role of negative real rates that are being offered to savers in the huge craze that has been created for this asset class? And then after that, we'll take on some questions from the audience. Darrell, do you want to go first?
Oh, sure. I think you've hit the nail on the head, Viral. Very low real rates have encouraged people to speculate on all kinds of things, trying to earn a higher yield. But in my view, they don't even need that. There's a certain amount of, I wouldn't call it mania, like tulip mania, but let's call it very high exuberance about investing in cryptocurrencies, just as they would invest in GameStop or Tesla, without necessarily running spreadsheets of discounted cash flows to figure out what it's really worth at a low real rate or at a high real rate. I don't think they're paying that much attention. There's just a lot of money swishing around with a speculative, let's call it somewhat of a frenzy. And yes, there could be a massive correction because, as Dr. Subbarao noted, most of these cryptocurrencies have literally zero underlying assets. They're simply made scarce by an algorithm. And so, it's worth whatever one is willing to pay for it. And we know what that can lead to.
Dr. Subbarao, do you want to have the last word on this?
Yes, which is to say that I endorse everything that Darrell said, which is that negative real rates are actually driving search for yield. And people are looking for other avenues to invest. And not that there are very many savings in a country like India at this time, but even so, there is search for yield. But I think the cryptomania is quite delinked from this. Imagine if there was no crypto, people would have looked for other possible avenues of earning. But the availability of crypto is, I think, somewhat of a mania, is a frenzy. It's like the tulip mania of the 17th century Dutch tulip mania. And my fear, and I think the government's fear, is that a lot of people are investing in cryptocurrencies driven entirely by I wouldn't say greed, but possibility of earning quick returns. And they might feel cheated. They might, in a poor country like India, that can be a huge tragedy. I think the government is concerned about it. So you're right that it is the real interest rates that are driving search for yield, but I think crypto is running on its own steam.
Thank you so much. We have time for some questions. May I request the audience to raise hands using the raise hands function? Ask only one question. If your question is directed to either Darrell or Dr. Subbarao, say so, but if it's for both of them, you did not say anything. Okay, no one has raised hands.
Pradeep, Pradeep has raised his hand.
Yeah, Pradeep has raised his hand. Yeah, Pradeep, please go ahead. Yeah.
Thanks, Viral. My question is first to Darrell, and as far as I see it, and I've heard this before, the central bank digital currency would be essentially equivalent to cash, in as much as certain cash which is not issued physically would be issued in digital form. So why should it impact deposit taking by banks in any way? Where deposit taking by banks, people earn interest. On the CBDC, people earn no interest. Why should anyone keep money lying around in a CBDC except for day-to-day stuff? And why should it have any impact on deposit taking by banks? I have another question, but you restricted me to only one question.
Pradeep, thanks. It's always a pleasure to get your questions. You ask hard ones. So the idea is, well, people are willing to hold paper money despite it's not paying any interest because it's convenient as a medium of payment. Let's suppose CBDC was so convenient in the following sense. If you thought that you might get a higher interest rate at Chase than you were getting at Bank of America, well, there's two ways to correct the situation. One is to log on to your Bank of America website and spend about an hour going through various hoops and loops trying to get your money moved over, which is I've tried. Or you can, if you're smart, you can hire an aggregator to move your deposits, or you can go to the ATM machine and withdraw paper money. Well, those are various degrees of convenience for the average consumer. But if the average consumer gets very adept at swishing their thumb on their mobile phone CBDC app and saying, swish, there goes all of my Bank of America savings into Chase or vice versa, then the banks are going to have to say, well, I guess we're going to either have to figure out how to put a block on this or we're going to have to pay higher interest rates because we're not going to keep our cheap deposit funding at this rate. So I think it does make a difference provided that CBDC is set up in an interoperable form that does provide that competition. Now, that's not guaranteed. In some countries, and perhaps including the United States, it will be left up to the banks how to deploy the CBDC. The Fed is not going to have everyone walking down to 33 Liberty Street to pick up their CBDC. They're going to have it go through the commercial banks, most likely. And if the commercial banks provide it in a certain form, using certain apps that are not that interoperable with other banks, then the premise of my reply to your question might be void. It might not do much more than what we have now.
Yeah, there is one question in the chat box, if I can direct it to Dr. Subbarao, which is, what is the likely impact of the CBDC on central bank accommodations, such as the measures it had to undertake post-COVID? I would also add to that the need to have lender of last resort be deliverable at a very fast speed if we are fearing runs of the type Darrell was just alluding to.
So the question is, how will CBDCs, how have they affected the pandemic management by the Reserve Bank of India?
Yeah, I think the question is more broadly, how do you see the central bank accommodative policy get affected by the presence of a CBDC? Will it be facilitated? Will it be required more often? Or will there be some difficulties in transmitting the accommodative policy?
Okay. See, at the moment, there is already facility for commercial banks to have accounts with the central bank. So there is already, banks are already, there is some sort of a wholesale CBDC available to banks, although it's not backed by any cryptography or blockchain. So banks already enjoy that, and they have the lender of last resort facility access from the central bank. So I don't see very much of a change there as far as banks' access to central bank money is concerned. It might become faster, it might become smoother, but I don't see much of a change there. But to link this question with the earlier question, which is about why should central banks offer any interest on CBDC accounts of retail people, retail CBDC accounts? If they offer this is the link with Pradeep Yadav's question. If central banks are already, if central banks are saying that CBDCs are cash and cash does not earn interest, there is no case for offering interest on CBDC accounts of people with the central bank. But I see a possibility that they might offer interest at some point of time, negative interest rate, for example, in industrial countries like the US, Europe, or Japan, might actually offer negative interest rates on CBDC accounts to make monetary policy more effective. Or even in countries like India, we're very far from negative rates, but even central bank can actually, the Reserve Bank can actually calibrate the interest rate on the CBDC accounts of people in order to make monetary policy more effective and to give traction to monetary policy. But I believe that that should not be done. I believe that there should be a rule that CBDC accounts of people with the central banks will not carry interest, because they're saying that CBDCs will be perfect equivalent to cash. And cash in my pocket does not earn interest. There is no reason why my balance in the CBDC account with the Reserve Bank of India should earn interest. But if central banks are tempted to offer interest, the game can change. And I don't know what ramifications that might have.
I think we are just out of time. And, yeah, Darrell, you can have the last word. Yes.
I was just going to second what Dr. Subbarao said and refer to the work of Dr. Ulrich Binzeil, who's the managing director for payments of the European Central Bank, who has actually written very articulate pieces supporting Dr. Subbarao's point that in a negative interest rate setting, you would want to pay negative interest, although they would accept. They would make an exception for retail size deposits. So it'd be a two-tiered system, small deposits, no interest, large deposits, negative interest. But as a political matter, I don't think any large central bank will pay positive interest, because they will be then competing with their commercial banks. And I've never seen a central bank that says, we want to compete with our commercial banks.
I think we are out of time, right, Koos? Or should I take a few more questions?
Can I make one point?
Let me just get intervention from Koos first, whether we are out of time or not, Pradeep. Then
I think, let me ask a quick question, and then I'll let Pradeep ask a quick question, and then I just want to thank all the panelists and close. Okay.
Sorry to interrupt you. We have many questions from our larger participant list. There are many of them.
Should we extend the time then by about 5-10 minutes, Chitsankar?
I think 5 minutes would be very helpful.
Let's check it's okay with Darrell and Dr. Subbarao.
Sure.
Are you guys ready to stay another 5 minutes? Is that okay?
Sure. It's okay with
Thank
me.
you. Let me ask a question which we've already treated, but I'm asking a particular. So we discussed the privacy issues. So in other words, CBDC represents major devolution of power to the government. Okay, so you guys talked about it already. My question about that is, though, even though Darrell talked about the data issues and so on, but the truth is, everybody, I think politically, it's a big worry that CBDC does represent the government seeing your transactions or things like that. Now, my question, though, is how would that affect the politics in US, in India, and in China, in the speed with which we make progress on the CBDC? Darrell, I know you can start, and then I'd like Subba to respond, please.
Okay, let me address quickly China and the US, and I'll leave India to Dr. Subbarao. So in China, well, the central bank has already decided under the government's direction, we will collect all the data, and that's that. And so there's no public discussion, really. But the US is a more interesting case. If you had asked this question 10 years ago, Koos, I would have said, well, politically, it's a non-starter. Americans are not going to say, oh, we want the government to collect all of our identities and payment data, even if the government were to say, oh, we have cryptographic methods for protecting you. By the way, China says it has, quote unquote, controllable anonymity or managed anonymity. But Americans would be skeptical of phrases like that. But if you scroll ahead 10 years, and Americans, particularly the commentariat, people like me, for example, but just the literate reader of the Financial Times is going to say, well, what the heck? China has advanced mobile payments. Cheap, well, not that cheap, but much cheaper than what America has. And it's fast. It's 24/7, 365. It's wonderful. What's wrong with the United States? Why can't we keep up with those people from China? We're losing the space race. And now the conversation has changed and the pressure is on the official sector. Probably it will be on from both sides. The two parties in Congress have reasons to support this, although they're not exactly the same. So let me stop there.
Subba?
Yeah, thanks, Kos. I think the answer to your question is in the realm of speculation. I can imagine what the government and the Reserve Bank of India will say, that we will protect your data. We will not use it for any purpose except for very authorized purpose, and they will specify when that can be used. But eventually, it will depend on the credibility of the government and the Reserve Bank of India. And in a country like India, where the opposition is very vigorous, there can be fake complaints, or there can be government misusing the data and covering it up. So I can see a lot of political complications coming out of this, but just because they have access to data. And data protection laws, as I said earlier, have to be very, very tight and have to be credible, have to be robust. And it's difficult how we're going to have draft such data protection laws, and more importantly, how we're going to enforce them. So it's going to be a very, very tricky technology issue, but as you said, it's going to be a very, very tricky political issue.
Thank you, Subba. Pradeep, and then, yeah, go ahead. May keep it brief because there are a lot of questions. Tirthankar has questions as well. Yeah,
absolutely. No, my point is about when Darrell said about anonymous wallets, or anonymity being introduced within the CBDC system once technology for that develops. First, I'm not really sure how stablecoins and CBDCs are different in terms of anonymity. Push comes to shove, everything it would be completely discoverable in a stablecoin framework as it would be in a CBDC framework. So I kind of struggle, given that stablecoins or any kind of crypto has this huge problem of attracting people for tax evasion purposes and that kind of usage. I find it difficult to see the rationale for the existence of stablecoins if we have good CBDC systems in operation for exchange. That's the only point I wanted to make.
Do you want, Pradeep, you want a response from either of them, or you're okay?
If Darrell and Dr. Subbarao could respond, that'd be great.
All right. Go ahead. You guys can pick.
Dr. Subbarao, please go ahead.
See, actually, I don't see a difference between Bitcoin and its clones and stable coins. They're the same from the point of view of privacy and data protection. I don't see why stable coins are more required or can promote financial stability, and which other cryptocurrencies are not able to do. So I do not see it exactly the way you see, Darrell, that there is of course a difference between currencies which are backed entirely by algorithms and currencies which are backed by stable currencies. From a point of view of financial stability, I think both are causes for concern.
Yes, I agree. And I think the private sector doesn't internalize the data security value that the government sector would internalize, and that the CBDC would be safer and more secure from a data viewpoint. But that's separate from the discussion we had a moment ago. Every day, most of us are signing on to some private service like Google, Amazon, your bank, and filling out forms with all of your personal data and then scrolling through 10 pages of fine print, agreeing without knowing it that you've allowed them to use all of your data. We don't think about that. But then we imagine that if we put all our data in a single government data repository, where anyone in the government theoretically could crack into that, we worry about that. We trust some, and I'm a Canadian, but many Americans would trust, perhaps incorrectly, a private sector person. Maybe it's related to government versus private sector, or maybe it's putting all of your eggs in one basket versus putting a few of your eggs in each of many baskets. But I do think a CBDC would be much more secure in the end, because the government won't allow it to go ahead unless it's very secure. The politics of that are pretty clear.
Tirthankar, can you kind of, what's the word? We have time for like 2 or 3 questions.
Let me summarize quick ones. So there's one, the question asks the panel's view on DeFi, the decentralized finance, which is very in vogue these days, which uses crypto tech to further financial development. What are the panel's thoughts?
Either one, please.
I can just chime in quickly. Go ahead, Dr. Subbarao.
No, go ahead. Viral, please go ahead. I don't know much about DeFi, so I think you're better placed to answer the question.
Yeah, I was just going to mention that, I've never understood this term, because I think finance has generally always been decentralized. So it's not like the central banks are lending directly. Maybe they used to at some point, but it's always been decentralized. I think the case for crypto tech based DeFi in India, again, in my case, is not very strong. We have the unique ID verification system. We have a very interoperable payments interface, and iSpert, which is the industry software products roundtable, that think tank which has built the India stack of apps for creating the pipes between various parts of the financial system. They've also created now apps for what is called as the Open Credit Enablement Network. In particular, they've created the concept of an account aggregator, which now the RBI has authorized, where a potential borrower can simply aggregate all of their digital records from banks, mutual funds, insurance companies, tax authorities, utility payments, etc., into a single view that with the borrower's consent can be provided to a potential credit provider. Banks and other fintech lenders can partner with e-commerce sharing platforms to deliver their loans, encapsulate the payments into the payments on the e-commerce platform for ease of collection, etc. So my sense is, in India, the Open Credit Enablement Network, rather than crypto tech, sort of almost the opposite in their language, is what is actually likely to create a digital finance revolution, I think, in the next 2 or 3 years, because we would have a standardized platform for delivering these products. There's going to be tremendous competition because anyone can use these apps using the account aggregator to do credit scoring and connect through e-commerce platforms to the end borrowers, be it individuals or be it micro, small, and medium-sized enterprises.
Thank you, Professor Acharya. Of course, there are many more questions, but I see Professor Damodaran is already here. So, in the interest of time, and it's about 8:30 here, should we move ahead?
Yes. Let me just thank the panelists. Guys, you did an amazing panel discussion. Even though I attend a lot of panel discussions, this has been the most useful and most educational. Thank you so much. I think do we have a break? 5-minute break? Is that right? Tirthankar.
In terms of time, we do really
You can take the break. It's okay.
You sure? Okay.
Yeah.
We'll take a 3-minute break just to look the other way and take a deep breath, because Aswath, our keynote speaker, is already here. So, yeah, let's take a 3